Hello, everyone. Welcome to the market opening bell on Monday, April 28th. As April nears its end, Hong Kong and global stock markets fluctuated upward last week amid concerns over US-China trade tensions. The Hang Seng Index surged to 22,268 on Friday, but later moderated gains after China denied discussions on tariff issues, closing at 21,981. The index rose 586 points or 2.7% for the week, marking its second consecutive weekly gain. The X-share index closed at 8,081, up 2.3% weekly, also rising for 2 weeks straight. The Hang Seng Tech Index ended at 4,983, up nearly 2%, snapping a 6-week losing streak. Mainland Chinese markets showed mixed performance on Friday, with the Shanghai Composite closing at 3,295, down 2 points but up 0.6% for the week. The Shenzhen Component Index closed at 9,917, up 39 points or 0.4%, with a weekly gain of 1.4%. The, the Political Bureau of the CPC Central Committee held a meeting on Friday to analyze the current economic situation and work. The meeting emphasized accelerating the implementation of more proactive macroeconomic policies, fully utilizing active fiscal policy and moderately loose monetary policy, and speeding up the issuance of use of local government special bonds and ultra long-term special treasury bonds. Timely cuts in reserve requirements and interest rates were proposed to maintain ample liquidity and bolster the real economy. The meeting provided support for the stock market, and the RMB central parity rate rose for 2 consecutive days to 7.2066 against the US dollars, up 32 pips from the previous trading day. In the spot market, the onshore RMB fluctuated around 7.28 early in the session, while the offshore RMB hovered around 7.29. Technical analysis: the Hang Seng Index rebounded 3,008 points from its April 9 low of 19,260 to Friday's high of 22,268, recovering most of the April 7 downside gap between 22,638 and 21,048. This rebound represents 53.6% of the decline from the March 19 high of 24,874 to the April 9th low, a total drop of 5,614 points. A 61.8% retracement could target 22,730, but with the 9-day relative strength index lingering around 50 without further strength, the rebound may be nearing its end. The first warning level for the end of the rebound is 21,600, with a second at 20,850. Company earnings: BYD for the first quarter ending March, revenue reached 170.3 billion yuan, up 36.3% year-on-year, but slightly below expectations. Net profit doubled to 9.155 billion yuan, up 100.4%, within the lower end of market forecasts, between 8.5 billion to 10 billion yuan. Earnings per share were 3.12 yuan. BYD's global sales exceeded 1 million vehicles, up 60% year-on-year, with pure electric vehicle sales surpassing Tesla, securing its position as the global EV sales leader. Despite the Lunar New Year holiday typically being a slow season, BYD's performance suggests a high likelihood of achieving its full-year targets of 5.5 million total sales and 100,000 exports. Stock analysis: the stock tested 400 Hong Kong dollars 3 times last week without breaking through. A breakout above $400 could target 414, with support at 375 to 380. BYD Electronic first quarter revenue was 36.88 billion yuan, up 1.1% year-on-year, with net profits at 622 million yuan, up 1.9%. Earnings per share were 0.28 yuan. Notably, gross profit fell 7.4% to 2.325 billion yuan. Technical analysis: the stock has failed to reclaim the 250-day moving average, which lies at 36.35 Hong Kong dollars, and may retest the 10-day moving average, which lies at 33.5 Hong Kong dollars. A break below could see support at 31.5 dollars. Companies announcing earnings today include Sinopec, Wuxi Aptec, Huaneng Power, Datang Power, Longyuan Power. Consumer stocks Qingdao Berry Brewery and Hisense Home Appliance, and the recently surging Rongchang Biologics. Investors holding these stocks should stay alert. US stocks closed higher on Friday, marking 4 consecutive days of gains. The Dow, after falling as much as 374 points, ended up 20 points at 40,113, boosted by Tesla, soaring 10% amid California's new autonomous vehicle testing rules. The Nasdaq rose 216 points, or 1.3%, to 17,382. The S&P 500 gained 40 points, or 0.7%, to 5,525. For the week, the Dow rose 2.5%, the S&P 500 surged 4.6%, and the Nasdaq soared 6.7%. The Golden Dragon China Index fell 27 points, or 0.4%, to 6,953. U.S. earnings: Alphabet first quarter revenue growth beat expectations, and a dividend increase lifted the stock 1.5%. Intel disappointing Q2 guidance and cost-cutting measures dragged the stock down 6.7%. On economic data, the April Michigan Consumer Sentiment Index was revised up from 50.8 to 52.2, but down from March's 57, marking the lowest level since July 2022, amid concerns over trade policy uncertainty and potential inflation resurgence. One-year inflation expectations jumped to 6.5%, the highest since 1981, though slightly below the initial 6.7%. Five-year inflation expectations rose from 4.1% to 4.4%. This week, markets will focus on earnings from tech giants like Microsoft, Apple, and Amazon, alongside key data on employment, inflation, and Q1 GDP. US Q1 GDP is expected to grow 0.4% annualized, down 2 percentage points from the Q4. March headline and core PCE inflation is expected to ease, with core PCE annual growth slowing 0.2 points to 2.6% and monthly growth dropping 0.3 points to 0.1%. April non-farm payrolls are projected to fall sharply to 130,000 from 228,000, with the unemployment rate holding at 4.2%. Our stock pick today is YesAsia Holdings, stock code 2209. YesAsia Holdings successfully achieved a business transformation and turned profitable in 2023. In 2024, the company focused on implementing a new global expansion strategy, acting as an authorized distributor for over 400 Korean cosmetics companies, with authorization covering multiple countries and regions worldwide. For most of its 27-year history, English-speaking countries such as the United States, the United Kingdom, Canada, and Australia have consistently contributed the majority of the group's revenue. In 2024, given the growing popularity of K-beauty in various other regions, the group allocated more resources to expand into non-core markets, defined as all countries excluding the US, UK, Canada, and Australia. The company's flagship e-commerce platform, YesStyle, offers the 5 European languages: French, German, Italian, Spanish, and Dutch. In August 2024, YesStyle introduced Arabic language support, driving development in the Middle East market. In 2024, YesAsia Holdings reported annual consolidated revenue of $345 million, a significant year-on-year increase of approximately 71.7%, accelerating from 56.6% in 2023 and reaching a historical high. Revenue from non-core markets excluding the US, UK, Canada, and Australia surged by 117%, with the share of total revenue rising from approximately 39.7% in 2023 to 50.2% in 2024. By region, revenue from the European Union grew by 91.3%, Latin America by 536%, and the Middle East by 178%. The group's profit for 2024 was $19.04 million, a substantial 151.5% increase from 2023, with the net profit margin improving from approximately 3.8% in 2023 to 5.5% in 2024. Looking ahead, the global expansion of K-beauty products is expected to continue in both core and non-core markets. The market size for K-beauty products is projected to grow from $13.59 billion in 2024 to $25.98 billion by 2032. The group believes K-beauty's popularity in several European countries is just beginning, and it anticipates that in 2025, continental Europe will surpass the US to become the group's largest revenue source. Additionally, the group will invest more resources to prioritize the development of its B2B business. Successful B2B expansion will help the group capitalize on the growth of the offline retail market, which is several times larger than the online market. Furthermore, B2B growth will enable the group to increase procurement volumes from suppliers, thereby improving supply prices and business profit margins. Recommendation: buy at 4 Hong Kong dollars, with initial target at $4.4, followed by $4.6. Stop loss at $3.75. I do not hold the above stock.